And that's why I'm in defensive mode right now, and I'm holding on to or adding positions in like long blue chip tech stocks, financials, and dividends right now, because this market is scary. What's going on here? Okay, number one, elephant in the room, Omicron. What do we know? Well, we know that originally they said it was from South Africa, then they found it in the Netherlands. Turned out that it was in the Netherlands before it was announced in South Africa, even though that's where it appears it came from. What else do we know? Much more transmissible. So now that we're getting more information out, we're seeing ungodly amounts of cases, right? We were seeing 200,000 a day in the UK. We're seeing it spread like wildfire everywhere. So you're saying to yourself, but Stocky, but from what we gather, there was only one death over there, so it must be less deadly. For now, yes. But there's two problems. Number one, even if it's less deadly, the fact that it can transmit faster and more aggressively means that even though seems to be so far a weaker version, people who are unvaccinated or didn't get the last two waves are at risk of getting this significantly higher because it's easier to transmit, right? Meaning we could see an uptick in deaths. But more importantly, we have a lot of people that are vaccinated now, right? More people vaccinated than the Delta variant and way more than during the original wave. So it's kind of tough to judge the deaths right now and the severe long COVID on it because so many people are vaccinated. But there's a lot of places in the world that have 0 or like under 5% vaccination rates. And that's where the concern is on that. Number two, another thing that's concerning is the faster it is to transmit, the more people it can get into and the more chances of a mutation. Maybe the mutation is more transmissible and even less deadlier or more deadlier. We don't know, right? These are things that can happen. So what's going on is we are seeing lockdowns again. We are seeing lockdowns all across the world, all right? Netherlands, full lockdown. UK, lockdowns. EU, lockdowns. China has a zero COVID policy. What does that mean? What does zero COVID policy mean? That means they don't want any cases. And if they have any cases, they are going to make sure that those cases go away very quickly. And how do they do that? Well, I mean, we saw videos last time of them welding people in their building, in their houses, right? I don't know. I'm not saying anything. Why does that hurt even more so on the tech sector and manufacturing production? Because if China starts locking down whole regions again, okay, if China starts locking down whole regions again, then what we're going to end up seeing is another slowdown in production, meaning more supply chain issues, okay? More supply chain issues. And China is basically the warehouse of the world, right? Their production, their storage, they're distributing. So that's another concern. Now, the US is not going to lock down. They've already made that very clear. Even though we have a different administration, different political party in charge, the US economy, they basically said, cannot sustain that. So the hardest hit right now are travel and leisure, because with lockdowns and travel restrictions, less international flights, less cruises, less vacation stays. There you go. Number two, you're seeing tech take a hit. Back to the China thing. You're seeing others take a hit for supply chains. You're seeing, pharmaceuticals go up because with more cases and more variants and faster transmission, you're going to need more boosters and more, whatever. We're seeing Novavax get that EU emergency use authorization. You're seeing Vir get their pill going. MRNA is the latest result came out. They're like 37 times more effective than originally thought. Pfizer said the same thing. However, one thing about Pfizer, guys, and I doubt this is going to get in the news because, let's be honest, these motherfuckers made a lot of money on erections, okay? And they're using that money to put a lot of money into lobbying and into commercials and to pay for sponsorships and ad revenue on news organizations. So is there a conflict of interest there? Maybe. However, Pfizer, New Zealand has now been the first government in the world to come out and link a death to a vaccine. They said that a young man, I think he was 26 years old in New Zealand, got the Pfizer vaccine and it caused inflammation in his heart and he died. Now, if that takes on into the news cycle, we may see a pullback on Pfizer like we did with AstraZeneca and Johnson & Johnson when they had their negative news. And that's why mRNA has been getting a lot of love this morning as well. Okay? So, that is number one. Number two, Build Back Better plan. Ladies and gentlemen, the Build Back Better plan started out at $3.75 trillion. Senator Manchin, in a 50-50 split Senate, who is on the Democrat side, because remember, in a 50-50 Senate, the vice president has the deciding vote if it's a split. And in this case, it's the Democrats, so technically they hold a majority. But one holdout turns that away. So, Senator Manchin has said to Biden, I'm not voting for that. It's too much money. It's going to be too much money on the deficit. You're not getting a spend. Where's the money coming from, right? It's just going to add to the deficit. So, over the past 6 months, they've been negotiating, and they brought it down to $1.75 trillion. And they said that it's going to be paid for by future tax increases. The argument that's been made against that is there's no guarantee that that's going to happen, right? You put that in for future tax increases, the Republicans win in the midterm and they reverse it, and now we've got this money on the books and no way to pay for it, so it adds to the deficit. That's basically a TLDR of what we've been told has been said. This weekend, all last week, Manchin and Biden were meeting to try and come together, and so this weekend, Manchin came out and said no. He said no and left. He said, I'm not voting for this. Too much money, too much spending, too much adding to the deficit that's already at $29 trillion and growing. And no, either bring it down or find a way to pay for it. So what does that do? That means $1.7 trillion in infrastructure projects, child health care, child tax credit, which money goes into people's pockets that have children. All that goes away for now, meaning that all of that consumer spending that was going to take place from that money flowing into, parents' pockets for the child tax credit, as well as, infrastructure projects, which when you build infrastructure, you have to get materials, which then makes companies make more money, which then they, have to order supplies to make that stuff. And jobs, it's a big thing, right? It's a big, what they call a stimulus, right? And so with that news that this has been nixed for now into next year, Goldman came out and lowered GDP expectations. Guys, before you get into political arguments about if the money will be spent correctly or not and how that, no, I'm not doing that. I'm just telling you what is out there, okay? I'm not a politics channel, okay? Go to Hassan or Destiny or somebody else, okay? I'm not going to get into that. We already know that most of the time this money is paid to pad pockets of certain contractors and certain, people, and then it goes to the lowest bidder, and everybody's trying to pocket as much of it as possible. The construction never gets done. The money gets so wasted. I get it, but that's not what we're talking about here. Goldman has now lowered the forecast for economic growth into 2022. Why is this a big deal? Well, because everybody said that 2022 was going to be one of the biggest economic rebounds in history. And it's still on pace to have that increase, but they've pulled it back. So what do investors like? They like stability and they like long-term growth. And the chances of the growth pulling back have had investors, especially in some of these stocks, they pulled back. They said, you know what, we had a run, we'll pull back, we'll wait for the next entry. We'll wait for good economic news. Now, what does that do? That also lowers treasuries. Why does that matter? Remember, and I did a YouTube video on it if you guys go to my YouTube channel. We're only 40 people away from 40,000 people on YouTube. Remember the yield curve? You want yields to be low here and high here on the 1 year, the 10 year, the 20 year, and the 30 year. You want that long-term projection for growth. That's what you want. You want your short-term bonds to pay shit and your long-term bonds to pay more, because that shows that we're expecting growth, right? You're basically giving an IOU to the government. Government's saying, hey, we expect growth over time, and so we're going to pay you good amounts of money over time because we expect that growth. Well, with treasuries dipping and yields dipping, and with GDP and growth potential being pulled back, as well as some of this other shit, we're looking like this right now. This becomes concerning because of number 3. If this happens, that is called a yield curve inversion, because instead of going up, it's going down. If a yield curve inversion takes place, that is historically the sign of a recession coming. Now, it inverts all the time, so we don't, not all the time, but it's going to invert for short periods of time. That's fine. But a sustained or growing yield inversion is the signal of a recession, because, once again, That is the future outlook of growth, right? The future outlook of growth, okay? So they're expecting a pullback in growth. What is a recession? 2 quarters or more consecutive of a GDP reversal, right? So that means 2 quarters of GDP going down, right? You're actually pulling back on your growth. Which brings me to number 3, which is moving the markets. The Fed, ladies and gentlemen, our favorite, Papa Powell, praise be, bless him and his flock. We have problems. Starts with number 1, asset purchases, okay? $120 billion per month. What does that mean? That means it's basically IOUs from the government. Hey, government, we're going to buy up 80 billion of your bonds and 40 billion of your mortgage-backed securities. We're going to keep buying it up and give you money in return. That's a lot of money getting printed. It's a lot of money getting printed. Now, I know modern money theory or, Keynesian economics or Austrian economics will take hold of this and say, well, inflation doesn't really matter, or printing doesn't really matter, or this doesn't matter, or it's too much. Let's just talk about what we know, right? We know that based on historical hyperinflations, now these were all failing states, so I'm not going to use them as a one-to-one in the United States, but Yugoslavia, Zimbabwe, Venezuela, Ukraine, right? We've seen runaway inflation. We've seen 300,000% increases in inflation. We've seen 217% every hour in inflation increases in failed states. We're not a failed state, so we're not concerned about that. But there is a point where money has to have a belief of value. Okay? People have to believe that something is worth. The only difference between a US dollar and monopoly dollar is what people are willing to believe it's worth. Why do people believe it's worth? Because of a growing economy, a strong, ability to pay back loans, a growing GDP, right? That's what keeps that dollar going. But if you just keep printing into oblivion, people will stop believing in the value of the dollar because it's just a supply and demand issue. So that's one problem. Number 2, 0% interest rates. Well, just 0% rates. Why does this matter? Well, this is how you bring an economy back, right? You lend money at 0% and tell people, take this money, build things, grow your business, buy houses, buy things in the market, keep people employed, keep things going, keep the GDP growing, and then give us the money back later on, no interest. People are more likely to take out a loan at 0 interest. Like, for example, if I offered you a mortgage on a house at 3% and you're like, I don't know, and then I offer you that same mortgage at 0%, would you take it? Yeah, you're more likely to take it because you don't have to pay back, 50% of it in interest over 30 years. Now, it's not a one-to-one, but it gives you an idea of why lowering interest rates tend to work. But these are short-term fixes. These are supposed to be short-term fixes until the economy gets, it's basically like that machine that's kind of stopped. And you got to crank it and crank it and crank it. And then once it starts going, the kinetic energy just keeps it going by itself, and then you just back off. Same thing with the Fed. They're basically cranking to get that machine going again, which is the economy, so that it can start running on its own. The problem is that if you keep cranking and cranking and cranking and cranking and cranking, and it's not running on its own, at some point you have to you have to get a new one, or you have to replace it or find a different fix for it. So 0% interest rates are great, but you can only do that so long, because what happens is now you've got more and more money just getting borrowed and borrowed and borrowed and borrowed and borrowed, and more and more debt, more and more debt, more and more debt, which is easy to pay back if you're making money on that money you're borrowing, right? So if you borrow $100 billion and you go out and buy $100 billion worth of real estate and you sell it for $110 billion, you give the $100 billion back and you keep $10 billion and everybody's happy. But if you buy $100 billion worth of real estate, even at 0% interest, and the real estate market pulls back to $90 billion, you now have to pay back the $90 billion you have left over plus $10 billion you're in the hole, right? And that's kind of what happens and leads to these failing economies. That's why interest rates can't stay at 0 forever. You have to raise it. You have to make money more scarce. Commodities, supply and demand. You want people to value it, right? If there's less, okay? How does this factor in? Well, that's where the dot plot comes in, right? Where we expect inflation to be. The Fed was saying it's transitory all year. Transitory. It's gonna cool off. It's not gonna last forever. Problem is that it keeps going up and up and up and up and up. They're still calling it transitory, but they're getting rid of that word. They're retiring the word transitory because they're basically saying, well, it's not going to last forever. Well, no shit, it's not going to last forever. Maybe what is it going to stop on a 90? What happens when you start getting inflation numbers that are 5-6% every single month? You're already doing this for too long, but now you got to stop it. But you got to stop it quick. Because you got to give yourself a timeline, whether it's March, which is what we kind of heard, or June. It's fine if you start in September of this year and slowly taper the asset buying and slowly increase those rates, because then the market can price that in and people can prepare for it. The problem is that when the economy's not doing what you think it is and you have to keep pushing it off and pushing it off and pushing it off to January, well, guess what? And that's what the concern is right now, is that the Fed is going to have to get more hawkish. And for those of you guys who don't know the difference between dovish and hawkish, dovish means they're kind of like letting things go and kind of chill and lax, and hawkish is like, we've got to like get this fixed. So between all of those things right now, we're seeing it moving the markets. Now, some things are good, some things are bad, some things are moving, some things aren't, whatever. But that is what's moving the markets right now. Not to mention the fact that 4 million people a month are walking away from their jobs, which is actually helping the economy, because for a little bit, because what happens is more and more people are walking away from their jobs, meaning that these companies are having to raise their incentives to get new employees, meaning the average personal income is actually going up, personal savings is going up, and spending is doing well. But that only works so well, because if we finish the year at, let's say, 5% or more on inflation, unless, and I said this before, unless you got 5% or more increase in your pay this year, you took a pay cut. And even if you didn't take a pay cut and you stayed the same, everything else costs more. And it's not just supply chain issues and inflation for producers, consumers too. Everything is going up. Everything. And this hasn't even got me started on the housing bubble and the eviction moratorium ending. So now it's a fight between not waiting too long to stop the printing, but not stopping it too soon either. Does this mean the market's going to crash? Does this mean the economy is going to go into a global recession? I don't fucking know. Nobody knows. But what I can tell you is that until we get stability, your spec stocks are going to get fucked up. And that's why I'm in defensive mode right now, and I'm holding on to or adding positions in long blue chip tech stocks, financials, and dividends right now, because this market is scary. Now, once the dust does settle, a lot of the stuff that you saw that's down 60, 70, 80, 90% from its high at the end of last year, this summer, is going to come back in a big time, because those are going to become value, right? Those are going to become what we call value stocks. So you're going to want to look for companies right now, at least defensive stocks that are healthy, right? Like not something that has a 3,000 PE ratio, but something that has positive cash flow and is lowering their debt, right? Their good assets to debt ratio. Companies that are, cutting costs, companies that have low PE ratios, stuff like that. There's several of them out there. That's kind of what I'm doing right now. Okay, that's just me. But the thing is that this is cyclical right now. And if you're in a good company that's just been beat up, don't worry about it. You're investing. You're not worried about the short term. Is anybody here old enough to remember the dot-com bubble? Okay. What was the dot-com bubble? Basically what we saw with growth stocks this past year. Except they weren't tech and they didn't have as much, there was a lot more money in the market, so it didn't crash the whole market. Dot-com bubble basically started in the 90s with the internet. And when the internet started gaining popularity, as it went from, niche to corporate to consumer, okay, and we saw users on the internet just go insane, we started seeing internet-based companies pop up everywhere, whether it was search engines, whether it was storage, whether it was computer companies, whatever. Hardware wasn't the problem. A few companies IPO'd and went to the fucking moon. I mean, what was it? Netscape or whoever it was, to the fucking moon, like 100% in one day. And it just kept running. And then the next one IPO'd and it just kept running. And then everybody got FOMO. And so money just started pouring into these online companies that were just websites or engines, search engines. They had no cash flow. They had no profitability. They had nothing. But everybody wanted to jump in and be in on the next big thing. Everyone wanted to be in on the next big thing. And so everyone poured their money in. They didn't care what they were buying it at. And we saw Pets.com is the famous one, but there was hundreds and hundreds and hundreds of them. And money just flowed into these companies that had nothing. And they were worth 10, 20, 30, 40, 500, 1,000 times what their book value was. But people didn't care. Everybody wanted to get in on this before the next big thing, not understanding that that's just too much spread out. Not all these companies, only 1 out of every 50 is going to be profitable at some point. And so, at some point, the bubble popped. And then the panic selling happened and it went down. Now, Amazon, I'm not saying any of these companies are the next Amazon, but Amazon was one of the companies that was caught in the collateral damage of the tech fall. They went all the way down to like $6 a share or something like that. They dropped 95%. But people who believed in them long term held or kept buying the dips. And then once the dust settled on that bubble bursting, they were one of the solid companies to come up from the ashes, and the rest was history. So that's happened with spec stocks this past year. Retail traders came in, stimulus money came in, 0% interest rates, asset purchases. There was ungodly amounts of money, and everyone was trying to get rich quick. Everyone was trying to get in the next hot thing. And we saw spec stocks and growth stocks go insane. Cathie Woods became an angel, a god from it. People saw every fucking spec stock go to the goddamn moon. We saw some of them go up 1,000%, 2,000%, 4,000%, 5,000%. And what has happened over the past 3-4 months? The same thing happened in 2001 with the dot-com bubble. The only difference this time is that because it wasn't the largest companies in the market or the highest volume, the highest market cap ones that were in the same sector, they ended up floating the market. That's why you saw, several stocks over the past 3 months down, certain sectors are down 60, 70, 80%, and others are up. Apple, Microsoft, Google, Facebook, Netflix, they've all carried the market. If it wasn't for them, we'd be in the same thing as 2001 because we just watched the big boys kind of hold the top here and everything else just go like this. All the small boys, all the spec stocks, growth stocks do that. But these guys carried us enough to where we kind of like did this. So nobody's really noticed all these others go down. And I could pull up a list. Somebody sent me a thing about Cramer's picks for 2021, and most of them are down between 50 and 80% because most of them were spec stocks, and the bubble burst. Just nobody noticed it because the big boys were carrying the market, and that's where all the money flowed to. All the big money that was selling on the way down to retail traders that were doubling, tripling, quadrupling down on their positions, took that money that they'd made that they bought here and didn't get out at the top but sold here. They took that money and they dumped it in the big boys. And that's why those have been kind of holding them steady while everything else has just fucking died.